Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that's transferable and then help you exit successfully on your own terms and conditions. In the last episode with Tim Van Miegham of the Proaction Group, we talked about what private equity buyers would want to know about your company before they stroke a check to buy it. And as we mentioned in the opening comments last time, there are a lot of pros and cons, of course, like with anything else, in selling to private equity versus a strategic buyer. And that's what we want to talk about today, the advantages of a private equity deal. And our guest today is Channing Hamlet. Channing is the managing director of the investment banking firm Objective, with more than 25 years of experience in investment banking and business valuation. Channing serves currently as execution leader for Objective's M&A and valuation practice and leads their business services practice. Channing, welcome to the podcast.
Yeah, thanks for having me. It's always excited to talk about investment banking and private equity and all that good stuff.
Hey, Channing, before we start drilling you with all of our incredibly insightful questions that our listeners have come to appreciate, I'm going to give you a chance to kind of describe what an investment banker does, because, you know, if you watch Hollywood movies, they're all like, what was that character was in that one movie where basically they're all like part of the evil empire, just out for money, and they suck everybody dry. So now that I've bashed you, I'll give you a chance to kind of redeem your profession.
Yeah, we don't have a contest at our firm on Monday morning to see who stole the most candy from a baby in the prior week, like other firms. You know, it's a good question. Investment banker can mean a lot of things. Like, and I think in the context of what we're talking about here, you know, we're mostly talking about like the middle market or the lower middle market. Most of the transactions that, you know, my firm is involved in are between 25 and a couple $100 million in value. So these are, you know, not tiny little companies, but they're smaller companies. They're typically privately owned. And so, you know, in that context, and a good investment banker, you know, kind of runs a process to help a business owner get their company sold. And, you know, I think the process can really be tailored based on the business owner's objectives, the industry, the attractiveness of the company, the number of buyers interested, et cetera. But, you know, generally speaking, a good investment banker would help up front with a lot of the putting materials together, developing supportable and defendable financial projections, and, you know, really figuring out not necessarily how to tell the story of the company, but how to tell the value story of the company. Like, what makes this particular business valuable, and why would an investor stretch in terms of valuation to buy it? And so that first phase is really setting up for success by developing a good set of materials that tell the value story of the business. And then the second step would be going out and marketing the company. And it's typically done in a very discreet way, using confidentiality agreements and carefully managing the flow of information. And the goal of this marketing process to figure out which buyers are interested and which buyers are interested on attractive terms. And then once you narrow down to a smaller group of buyers, kind of invite them to see more information and make a best and final offer in the form of a letter of intent. And then negotiate the best possible deal through the letter of intent, and then work hand in hand with the company through the legal documentation and closing process. That's kind of what an investment banker does. And the last thing I would say about this is the benefits of hiring an investment bank and running a process there's a handful of things that we've learned over the years that our clients really benefit from. One is you maximize the price and the valuation. That's pretty obvious. A second one is most business owners have owned their companies for a long time, and they've put a lot of blood, sweat, and tears into their business. And so by running a process, it gives them a good sense of what the market is for the business and what the alternatives are, which buyers are interested, what price, what's their plan with my business, et cetera. So that when it comes time to sign on the dotted line, that there's not a lingering feeling in the back of their mind that there's a better deal out there. You've canvassed the market and you've got the best deal you can get. The third thing is, and we see this a lot, is our clients really enjoy meeting multiple buyers and finding the one that is the right fit for them and their company and their stakeholders. And we've had a lot of our clients, they're coin operated and they don't necessarily care what happens with their business. They want to sell it for the highest price. We've also had a lot of clients who are very careful about who they let own their business. They want to make sure their employees are taken care of, their customers, their vendors, and all of their stakeholders. And so we've had clients that have selected not the highest price, but the best fit for their company. And then, I think finally, this process really sets the foundation for a business owner, a business seller to really know that there's a foundation for a good decision. 2 to 3 years after the deal closes, they know they went through a thorough process and they made the best decision that they could make with the information they had at the time. And so I think a good investment banker typically would run a very comprehensive process tailored to the client's needs, and then really kind of accomplish that price maximization, and I'd say decision security is really kind of what an investment banker does.
That's outstanding. In regard to a seller can sell to what would be considered to be a strategic buyer versus private equity in regard to third-party sales. And two questions. Let's make sure that listeners are clear first, Channing, on what the difference between a strategic buyer and a financial buyer, private equity. And then two, is your process the same for each?
Yeah. So I think there's definitely shades of gray in this whole thing, and so I owner really needs to ask a lot of questions of the buyer to understand their strategy and their plan for the business. And certainly there are strategic buyers that act like private equity firms, and there are private equity firms that act like strategic buyers, and it can be a little bit confusing. So the first thing I would say to answer your question is ask a lot of questions and do your research to make sure you understand who you're actually talking to and what their plan is. That being said, a strategic buyer would typically buy a company because they want to bring that capability in-house and leverage it across their business, whether it's getting into a new geography, getting into a new customer base, adding some product or service capabilities or something like that. Typically, they would buy 100% of the company. Typically, it would be an all cash deal. Perhaps there would be an earnout. Typically, there's not an ongoing ownership component for the seller, and typically there's not an ongoing long-term role for the seller. And so for someone that is really looking to transition out of their company and they want a cash deal, a strategic buyer can be a really good fit. I think the thing to recognize is, as a seller, you're giving up control, and your business is likely over time going to be folded into some big empire and change in ways that you didn't anticipate. On the flip side, a private equity firm typically is a nice kind of put the toe in the water towards a sale. A private equity firm, typically would buy a controlling interest in the company, typically between 60 and 80%. And so the seller winds up with a very significant check at closing, and then they wind up with a rollover equity interest in the company. In many cases, the seller would continue in the same role that they're in before the sale, and they would own a portion of the company, and they would have access to, a private equity firm and their capital, perhaps to do some things that they weren't able to do with their own capital going forward. And then the goal typically is a partnership with a private equity firm to, for some period of time, 3 to 5 years typically, continue to build the business and put the pieces in place so it can be sold at a higher price in the future. And everyone's heard the term second bite of the apple, where that equity rollover piece could be sold for hopefully a 2, 3, 4, 5 times multiple of what it was valued at the first time around. And certainly when we've had clients work with private equity firms, the second sale can be equally or more lucrative to the first sale. And so if I were just to summarize this answer high level, a strategic buyer is typically taking control of the business and letting the owner transition out right away. A private equity firm is typically a partnership with the seller where they work together to continue to professionalize and build the business so it can be sold a second time in 3 to 5 years. The last thing I would say here is we often encourage our clients to evaluate both paths in a sale process. I think private equity has a fairly negative reputation in the press of, showing up with spreadsheets and recommending cost cutting. And I think that was true 25 or 30 years ago. The market's gotten so competitive that private equity firms have invested a lot in systems, tools, and resources to help the companies they invest in grow. And so private equity can be a really nice partnership. Most of our clients have a very negative view of private equity because they've heard the stories of how private equity have bought companies and screwed them up. More often than not, private equity firms come in, they're a good partner, and it's successful. It's just that those stories aren't interesting. No one tells the story on the golf course like, oh, I sold my company to a private equity firm. It was super boring. Everything worked out well and we made a lot of money. Like, that's not the story that gets told. The story that gets told is the one where something went wrong. So I think at some level, private equity has a reputation that may not be fully deserved.
So based on what you're saying, it sounds like you really need to be involved pretty early. I mean, we always talk about, we like to be involved early, like, years in advance to kind of, number one, help them decide whether some type of internal transaction is going to make more sense for them or go the route you've been discussing. But if they make the decision that they're going to be looking for an external buyer, at what point do you like to be involved?
Yeah, I think getting involved as early as possible is helpful. And I always encourage business owners to, investment banks will do a lot of free work and advice as part of creating a relationship. In terms of our business, we invest a lot of time and energy in a transaction, and we don't get paid until the very end when a transaction closes. So we enjoy creating a relationship with potential clients well in advance to understand them and their business and be really confident that we can come in and help them get a very good deal done. And so business owners can take advantage of that and get a lot of free work and free advice from investment bankers. So that's something I always encourage people to do, is to really educate themselves on the market. But I think a buyer, whether it's a strategic buyer or a private equity firm, comes in and does an enormous amount of due diligence, and most business owners and business sellers that haven't gone through it before don't fully understand it. And so the more we can educate someone on how to be prepared for the sale, how to mitigate and engineer potential issues out of the business before a sale, the more successful we can all be when it comes time to, run that process and do a sale. And so I think what you'll find with, with my firm and most investment banking firms is we don't necessarily come in and do formalized consulting to help with exit preparation. There are a lot of people out in the world that do that, but we're very good at kind of helping identify things to work on to either increase the value of the business or increase the salability, the salability of the business. And so, meeting a company multiple years in advance is often very helpful for them and very helpful for us. And
Yes.
one other thing we're seeing a lot of, particularly in this market, where I think the mergers and acquisitions market is a little bit slower, but both strategic buyers and private equity firms have a lot of capital. Good businesses are constantly being solicited. And so having a relationship with an investment banker can be helpful, so that if you do get unsolicited interest and it makes sense, you already have sort of the team and everything ready to go, and you can capitalize on the opportunity.
Yeah. So Channing, I think you've mentioned a couple of advantages to private equity over strategic buyer earlier, but let's just, is there anything else that you would say, specific advantages that you haven't mentioned yet that we should mention?
I think the one thing that I spent a lot of time thinking about is many business owners, the largest asset they own and their family owns is their company. And so private equity can be a really nice tool to diversify their investment base by selling either a non-controlling interest or a controlling interest in their largest asset, so that they have a properly diversified portfolio, and they reduce their concentration of risk. And so when I see someone who has kind of gotten to the point with their business where they view it as much as an investment as they do their lifestyle, that's where private equity can be a really nice tool to financially diversify. But they can still keep, if they pick the right private equity partner that's not going to come in and meddle, they can still keep their job, they can still run their business, and not a lot changes about their day-to-day, except for the fact that their financial portfolio now has a big component that's outside of the business. And so to me, I think that's like one of the very significant benefits of private equity, is to allow someone to kind of keep their day-to-day the same in terms of running the business, and then be financially diversified. And I think it can be hard for business owners to do. And then the second benefit of private equity is it creates a pathway for someone to transition out of the business gradually over time by building a management team, and maybe they step back and become a chairman or a board advisor, and no longer active in the day-to-day over a period of time, rather than like cold turkey if they sold to a strategic. And so I think those are really kind of two of the sort of biggest benefits I see with private equity. I think a lot of business owners, when 100% of their assets are tied up in their business, it's hard to turn over. It's hard for them emotionally and psychologically to turn over control. It's a lot easier once they've had that financial diversification and they have the peace of mind. So we've seen a lot of our clients that have sold or done transactions with private equity communities shift their mentality from like, I've got to go to work today to make sure my company stays in business because it's my biggest asset, and I'm really nervous about this risk and I'm really nervous about that risk, et cetera, to 2-3 years after the deal closes, that they've taken a bunch of money and invested it outside of the business, and now they're sitting there like, hey, I get to work on this one asset that I own 25 to 50% of. I've got a partner with capital. There's all these opportunities that I can capitalize on, and I'm having a lot of fun with this. And so we've seen a lot of our clients just like enjoy it a lot more once they've kind of taken some of their personal risk off the table. And so I really think that's sort of the big benefit here. And then the second benefit is often the business legacy remains intact, in that the business can remain independent and it doesn't get rolled into some other big company and get changed. And so there's a little bit more there's a little bit more control and input on
Yeah,
sort
isn't
of
that
the
true?
next
Is
legacy of
that
the
true
company.
though? Excuse me, is that true though until the second sale?
Yes. So I mean, I think that's really the big negative of doing any transaction where you give up control, is you give up control. And so you may sell to a private equity firm and have a plan to work over 3 to 5 years to build value. But in the second time you sell, you're likely, as a seller, not in control any longer. And it could go to a strategic, it could go this way, it could go that way. And whatever is going to happen is out of your control. So that really is the big negative. If you do a private equity transaction, you are starting the clock towards like completely giving up control. It just, most cases, it's like a half step. The first step is kind of a half step.
Mhm.
But yeah, you're exactly, I mean, you're exactly right.
Yeah, so a couple more questions. The early on, you mentioned your firm, mid market, 25 million to 200 million. Not a few of our listeners are below the 25 million. What are their options? Or uh, for those who are they've had their business valuation, maybe Walter's done it, maybe we've done it, maybe you've done it, and it's much less than 25 million. Let's talk about what their options usually are if they have any interest in selling either to a third party or a strategic or private equity when it comes to investment banking firms.
Yeah, I mean, I think when you go talk to private equity firms, there's a large number of private equity firms that are interested in investing and getting involved in businesses that have 10 million or more in earnings, EBITDA. Um, Above 5 million in EBITDA, there's a pretty good number of private equity firms that are interested. You know, over the last kind of decade, as more and more capital has been invested in private equity, we're seeing more and more interest in companies that are kind of 2 to 5 million in EBITDA. And so once a company kind of hits 2 million in EBITDA, there's enough. It depends a little bit on the market sector, et cetera. But there is interest from the private equity community in getting involved in those companies. The valuations are often a little bit lower as far as a multiple, but there's definitely a market for them. Another thing that we see a lot of is these companies that are in this sort of like 10 million, 15, 20 million enterprise value range often will be very attractive to companies that are owned by private equity firms, where private equity would invest in a platform business, and part of their strategy is to grow through acquisitions. And so they would look to do kind of smaller, quote unquote add-on acquisitions over time. And often those can be very attractive to sellers because it gives them a bigger playground to play in. It gives their company more resources. It creates career opportunities for them and their people in larger companies. And so that type of a framework can work really well. I think for businesses that are kind of below 10 million, kind of a 10 million valuation, it's a lot harder to find private equity. It's a lot harder to find private equity interest. And so those are typically sold to competitors or or something along those lines. However, on a sector by sector basis, you can see things like that happen.
Mm-hmm.
Hey, Channing, let me ask you one more question before I close this out. And we really appreciate you joining us today. From a fee structure standpoint, usually what I've seen is the investment banker takes a percentage, and it's kind of the percentage goes down as the sales price goes up. Is that the norm?
Yeah, so I think what you'll see is most firms like ours and most investment banks would charge a monthly retainer, and so we typically would charge a monthly retainer, call it $10,000 or $15,000 a month, and then we would fully credit that against any success fee paid in the future. So it doesn't necessarily cost, if you're a business seller and you're paying an investment bank a retainer, it doesn't cost any more. It gets credited against the success fee. and an investment bank puts more labor into a project than the retainer pays. And so it's kind of a co-investment in the overall deal with, with our clients, which is a really nice alignment of interests. And then you're exactly right. The success fee percentage typically would tier down. The percentage would tier down based on the overall valuation. And the percentage is set typically based on perception of valuation and perception of difficulty of completing a transaction. And one thing that we do, and I think a lot of investment banks do that clients really like, is often we'll set a lower percentage up to a certain price and then have a higher percentage above. And so there's kind of an alignment of interest or an incentive for the investment bank to work extra hard to create a premium valuation, because there's a little bit more of a super incentive there. Yeah. So that's a structure that a lot of our clients really like, and we feel like it aligns interests really well.
Yeah. Well, thanks. This has been great. I think between this week and last episode, our listeners have really learned a lot about what investment bankers do and private equity and everything else. So I think it's been a really, really helpful period. So thanks so much for joining us today.
Yeah, thanks for having me. I really always love talking about investment banking and private equity. So, if anyone has questions, they're absolutely willing to have a conversation.
Okay, so that was my final question to you is, how can our listeners get in contact with you?
Yeah, our website, objectivecp.com is it's out there, and my contact info is there. And so feel free to shoot me an email or give me a call or look me up on LinkedIn.
Okay. Great, Channing. Thanks again for joining us.
Yeah, thanks so much.
And listeners, if you want help in maximizing the value of your business or planning for your eventual exit, you can reach Pat at 301-859-0860. And you can reach me at 301-951-9090. If you've benefited from today's episode, please consider liking and sharing it on social media. And as always, thanks for listening. And until next time on the Exit Readiness Podcast, this is Walter Dial and Pat Ennis signing off.